Hello everybody, Thomas here. Looking forward to another video. And we're going to be talking today about another stock in the tech industry. There's a lot of focus on artificial intelligence and the companies that are involved in that technology. Today, I want to talk about another major player in the entire tech industry, as well as certainly in AI, and that's Microsoft. A lot of experts talk about stocks like NVIDIA, Apple, Microsoft, and others as stocks that you simply buy and hold forever, and you never actually try to trade them. I think there are some reasons that you should think about doing otherwise, and those are some of the things that I want to talk about with you today. So let's dive straight into it. This is our chart from TradingView on Microsoft. And we can see, like a lot of stocks in the tech industry over the past few years, stock has really experienced a big run upward over the last few years, going all the way from about $140 roughly in 2020, all the way up to a peak just a couple of months ago at around $365 right up here. And so great big long-term trend. We did see a downward trend on the stock through most of 22, the early part of 2021. Through the past year, the stock has experienced a really large rise. Now, it has come back, as I mentioned, over the last couple of months off of that high at around $365. And that drop so far in the last couple of weeks, that's pushed the stock below its 20-period moving average line, which right now is about $325. This week, it looks like it's picking up some new steam. For a lot of people, this kind of pattern, this little retracement within a much longer upward trend. Let me redraw my retracement line here. This retracement looks like a good opportunity to do what a lot of traders like to do, and that's buy the dip, especially when you see the stock find some support and then start to bounce higher, which the stock is doing right now. The problem with this is that when we think about these kinds of retracements in the context of the patterns that I like to try to identify for the Rebel income system, especially bullish level 1 kind of patterns, the probabilities are really not very good right now. Let's just look at the chart here for a minute, just to recap. You know, an ideal bullish level 1 setup comes when you see a 200-period moving average flat or sloping upward, as Microsoft was in September of last year. That's a very nice trend there. And then you see the 200-period moving average trailing down, starting to get near to the 200-period moving average, but then it flattens and possibly even begins to slope up. The combination of these two moving averages starting to approach each other in this fashion provides the setup for what ultimately is a much higher probability trade. Let me just clear out my arrows for a minute here, because I want to point out we like to focus on the actual signal coming from price action, usually with the formation of a hammer. We see that right here where the stock formed a hammer. It looks something like this. And sorry, it's not nearly, my drawing is not nearly as neat as the candle itself, but that's a good example of a hammer. I like to treat the hammer itself as a good signal to place the trade. Traders who are looking for a higher probability setup may wait an additional week and look for a confirmation candle, something in the form of a bullish engulfing candle, which is what we had similar to here, was follow through on the bullish momentum upwards that we can see gave the stock a lot of momentum to push up to this peak at around $365, $366 a couple of months ago. So that is the ideal setup that we're looking for. The problem then with the stock's current pattern is that the longer the stock extends upward here, the harder it becomes for this trend to sustain itself, especially considering how aggressive Microsoft went up over this period. becomes very hard to sustain this kind of bullish momentum. And so a retracement down off of this is kind of inevitable. Now, as I mentioned earlier, this initial retracement is something that a lot of traders like to treat as a buy the dip scenario. But in many cases, what happens, remember that this drop off of this peak creates a new level of resistance right up around this peak. And I would actually put it probably right around here at $345, which is closer to where the stock had closed and kind of lines up with this prior high from back in 2022. That additional resistance then means that a lot of people who buy this original dip, they go ahead and do this, they may see some upside up to about this level. But the higher probability is that as the stock nears this resistance level, it's going to fail again. The bullish momentum is going to fail to sustain itself. It's going to drop back again and could very well fall below any prior support levels and possibly, in the worst case scenario, form a new downward trend. So we like to think of this area where we see the stock has found its initial pivot low point to reverse and move higher as kind of a buyer's trap. So I'll just write that here. Because there's a much higher likelihood that the stock could fall, in which case you have to start to wonder how much further could it go. Well, the stock came very, very near to the 38.2% retracement line I've drawn with this Fibonacci trend line here at around $309. I would expect that there should be some additional support in this area. That's about $20 away from the stock's current price, with only about $20 of upside, maybe a little bit more than that. So you're looking at a reward to risk ratio under the best case scenario right now. I'll just do reward to risk, R to R, is about 1 to 1 right now. That means that you don't have really good probabilities under ideal circumstances for the right kinds of buying opportunities. You should be looking for reward to risk here of at least 2 to 1. And if you can get better, then that's usually preferred. So right now you're looking at only about 1 to 1, which doesn't give you very good probabilities of success with this particular setup. If the stock doesn't hold at 309, we could see it drop all the way down here to the 50% retracement. Remember that in many cases, when a stock forms a strong upward trend like this, when it begins to lose bullish momentum, it will often retrace at least 50% of that trend before finding its next support point, which in this case is around $290 per share. That's about $30, $35 away from the stock's current price right now. So this is a very dangerous position for the stock to be in if you're thinking about buying it right now, because right now you're talking about just down to the 38.2% retracement line, about 16, almost 17% downside from the stock's previous peak at around $367, and about 21% at around the 50% retracement line. So if you're going to buy it now, you're taking a much larger chance of having to sit and watch the stock continue to drop. Now, along with this, despite whatever I may see from the stock's price action, I try to make sure to pay attention to the company's fundamental strengths as well as its value proposition. Stocks, even in extended upward trends, don't always outpace their fundamental strength. And as I mentioned, there's a lot of focus being paid right now to stocks in the AI space for a lot of good reasons. There's a lot of demand in that area right now. And for companies like NVIDIA and a lot of others, those are driving profits that are keeping a lot of these stocks trends in place. So if the fundamental strength is still there, if the value proposition is attractive, it doesn't mean that just because it's been going up that it's automatically a bad value. So I want to try to see if that may be the case, or if my fundamental and value-based analysis lines up with what I'm seeing on my chart. So Really quickly, I'm going to look at free cash flow. I'm going to translate that into a free cash flow yield number. I'm going to pay attention to cash relative to long-term debt. That's looking at the company's balance sheet to see what kind of financial position the company is in. I like to pay attention to their operating profile by analyzing the company's net income to revenue. Whether or not the company pays a dividend is also something that's important to me. I like to filter the stocks in the marketplace based on whether or not they pay dividends. With the stocks that I focus on in the Rebel income system, I never use a stock or invest in a stock that doesn't pay a dividend. Valuation metrics are pretty straightforward. Pay attention to price to book and price to cash flow ratios compared to their historical norms to see if their current levels may represent a discount to the way that the market has historically treated the stock, and try to use that to provide a basis for any buying decisions I may make in the long term. Here is a summary of the fundamental profile for Microsoft. As you can see, there's a lot of interesting information here that points to strength. Free cash flow is very, very strong at almost $59.5 billion. That's right. This is a company with a market cap at about $2.4 billion as of today's market close on August 23rd, 2023. Interestingly, over the last quarter, this number has increased by a little over $2 billion over the past year. However, it is down by about $4 billion from about 63.3. On a free cash flow yield basis, it's a modest 2.5%, but this is just the sheer size of the number, $59.5 billion on a $2.4 trillion stock. Is something that lends a lot of strength. Company's balance sheet is in excellent shape. In fact, I would call it a fortress level balance sheet, given that there's more than $111 billion in cash compared to about $48 billion in long-term debt. That means that even if the company's profitability was declining, they would still be able not only to service their debt, but to pay it off with available cash with a lot of room to spare. We can see that cash has been increasing throughout the course of the year from about $107.2 billion a year ago. More importantly, over the last 9 months, from about $99.5 billion. So we've been seeing a healthy increase there. Long-term debt is somewhat higher than it was a year ago, and certainly much higher than it was in the last quarter, but still not something to be alarmed about. Remember, companies use long-term debt for a lot of other purposes that aren't necessarily bad. A lot of them go into funding capital expenditures, acquisitions, research and development, those kinds of things. The company's profitability metrics also show a lot of health. I like to compare net income. I divide net income by revenue to arrive at a profitability metric. In this case, over the last trailing 12-month period, this is 34.15%, which is extremely healthy. That's why I have it listed in green. And it increased in the last quarter to about 34.5%. So very healthy increase in the last quarter compared to the last 12 months. Stock does also pay a dividend of $2.72 per share relative to the stock's current price. That means that the dividend yield is a little bit less than 1%. More important element here is that the stock does pay a dividend. In terms of its value proposition, my fair value target is only a little bit above the stock's current price right now at about $336.50. More to the point, the price where I would be interested in looking at the stock as a serious buying opportunity is quite a bit lower at about $269. Let's go back to our chart here for a moment, and let's talk about that $269 level. I mentioned previously that if the stock doesn't maintain this current upward momentum that we've seen so far this week, it could fall back, test this support level about 309 from the 38.2% retracement level, possibly even the 50% retracement at about 290. I mentioned that I would want to see the stock at around $269. So that's just a little bit above this line right here, somewhere in this neighborhood. That means that the stock is about $60 away from that ideal buying price right now. So there's a fair amount of downside here, just a little bit above the stock's 200 period moving average, before I would want to take this seriously as not only a good value-based opportunity, but it would probably need to get to about this level before seeing the 200 period moving average, along with the 20 period moving average starting to form the next high probability bullish level 1 pattern. So there's more downside in the stock right now, more reason to wait and hold on. This is a fundamentally solid company, but the probabilities are just not right there right now. And for all of those reasons, right now, I am calling Microsoft a buyer's trap. Thanks everybody for your time. Hope this has been useful. We'll see you again soon.